Welcome to the fifth episode of Dividend Investing Insights, your go to source for all things dividend investing. Join us as we explore techniques to maximize your investment returns. Subscribe now and take control of your financial future with the power of dividends. Before we start this week's episode, a quick recap for the week. The share markets moved up with S&P 500 gaining 1.39%. Nasdaq 2 gained 1.29%, and here locally ASX 200 gained 0.66% to end at 8,023 points. Anyway, as I have said earlier, as a dividend investor, you should not be excited or alarmed by these movements as share prices go up and down all the time. And you, as an investor, should focus on companies that have the ability to pay consistent dividends in the current year and increase dividends in the years to come. In the episode last week, we had looked at price to earnings ratio and price to sales ratio. This week, we will look at two more ratios, which is the price to book ratio and price to cash flow ratio. I'm a big fan of price to book ratio as this gives insights into the real financial position of the company. Anyway, let's start with the price to book ratio. Uh, a price to book ratio measures the company's current stock value divided by its book value per share. A PB ratio of less than 1 could be considered as an indicator for an undervalued company. To calculate a PB ratio, we divide the book value per share by the market price of the share. The book value per share is determined by subtracting liabilities from assets and dividing it by the total number of shares outstanding. Let us look at this via an example. One of the four large banks here in Australia is ANZ Bank. It has a good dividend yield. It pays dividends twice a year and has been consistently paying dividends since 1979, and most of these years has increased dividend. Um, a quick reminder of the PB ratio being the market price per share divided by book value per share. As of this recording, the market price of ANZ Bank is 29.30. Viewers might recall that last week when we did the recording, the value of ANZ Bank was 29.59. However, we will consider, for our purposes, we will consider the current market price of 29.3. Some investors take a 3-month average to determine these ratio, but for our purposes, we'll go by the current market price. Now, to determine the book value per share, which is the other part of the formula, you have to subtract liabilities from assets and divide it by the total number of shares outstanding. ANZ Bank, as of the end of financial year 23-24, had assets of $1,105.6 billion versus liabilities of $1,035.6 million. It's not billion, it's million. And a total outstanding shares of $3 billion. If you apply all of these values into the formula, this will give you a book value per share of 23.33. Dividing it by the market price gives a PB ratio of 1.25. Now, is 1 point a price to book value ratio of 1.25 good? Yes, it is. Ideally, anything between less than 1, between 0 and 1 would be considered to be good. Anything is if it is negative, which means that the liabilities are higher than the assets. It's a straightforward no, we should not go for those companies. However, if the price to book ratio is closer to 1, slightly less than 1, that's the best indicator of an undervalued company. And since share prices go at a premium, a PB ratio of up to 3 is considered to be good. Let us look at the next ratio for today, which is the price to cash flow ratio. A price to cash flow ratio is a stock valuation indicator or a multiple that measures the value of stock's price relating to its operating cash flow per share. So unlike the other ratios, this is looking at the operating cash flow against the market price. And as with the other formulas, it is measured as market price per share divided by the operating cash flow per share. Again, we will look at ANZ Bank. ANZ Bank is what the example that we've looked at all along. So ANZ Bank, again, reminding the formula, market price per share divided by operating cash flow per share. ANZ Bank, as of this recording, has a market value of $29.3 and operating cash flow of 6,488 million and outstanding shares of 3 billion, which gives a operating cash flow per share of $2.16. Important to note as to how do you get this operating cash flow. The operating cash flow appears in the cash statement of each company's financial statement, appearing as net cash. Net cash includes depreciations and any other financial representation that is needed from a cash flow perspective. And you should consider the net cash as the position as the operating cash for an organization. So applying this formula gives an operating price to cash flow ratio of 13.54. Now again, is a PCF ratio of 13.454 good? Ideally, in an ideal scenario of price to cash flow ratio of 1 is perfect. However, a price to cash flow ratio of under 20 is considered good. Price to cash flow ratio finds an advantage in comparing shares of similar industry. The price to cash flow ratio measures how much cash a company generates relative to its stock price, as measured by the price of the earnings ratio. So this brings us to an end of the episode today. To conclude some important points, the financial ratios should not be looked at in isolation. They should be used as a reference and compared against similar industry shares. Next week, we'll apply all the financial ratios to four large Australian banks and see how do they stack up against each other. So, to all those who are still watching the episode, putting the checklist again, I encourage you to use this checklist, assess shares, and most importantly, subscribe to the channel, like the episode, provide comments so that we can provide more insightful videos to you. So until next time, thanks a lot for watching until the end, and see you soon for another interesting episode of Dividend Investing.